What is the difference between IRS Form 1120 and IRS Form 1065? Have you ever wondered how different business structures impact your tax responsibilities? Today, we are going to clarify the distinctions between IRS Form 1120 and IRS Form 1065. Understanding these forms is essential for anyone involved in business, whether you are a corporation or a partnership. First, let's talk about IRS Form 1120. This form is used by corporations, including C corporations and limited liability companies that choose to be taxed as corporations. When a corporation files Form 1120, it reports its income, gains, losses, deductions, and credits. The corporation itself pays income tax on its profits. If those profits are distributed to shareholders as dividends, those dividends may be taxed again on the shareholders' personal tax returns. This situation creates what is known as double taxation. However, corporations can take advantage of various tax deductions, such as salaries paid to shareholders and employee benefits, which can help in tax planning. Now, let's shift gears to IRS Form 1065. This form is designed for partnerships and multi-member limited liability companies that have not elected corporate tax status. Unlike Form 1120, Form 1065 is an informational return. This means the partnership itself does not pay income tax. Instead, profits and losses pass through to the individual partners or members who report their share on their personal tax returns. This pass-through taxation avoids double taxation, making it an appealing option for many business owners. When it comes to eligibility, Form 1120 is specifically for corporations and limited liability companies that elect corporate tax status. On the other hand, Form 1065 is used by partnerships and multi-member limited liability companies by default. Next, let's discuss deductions and tax planning. Corporations filing Form 1120 can deduct salaries, bonuses, and fringe benefits, allowing them to retain earnings within the company. Partnerships filing Form 1065 have the flexibility to allocate income and losses among partners, which can be beneficial for tax planning. In terms of filing complexity and costs, Form 1120 often requires more detailed accounting and may involve higher administrative costs. Form 1065, while needing careful record-keeping and partner reporting, is generally less complex. Another key difference lies in self-employment taxes. Partners in a partnership filing Form 1065 typically pay self-employment tax on their share of income. In contrast, shareholders in a corporation filing Form 1120 receive salaries subject to payroll tax, and dividends may not be subject to self-employment tax. Lastly, it is important to note that an LLC must consistently use its chosen tax classification year after year, unless it formally changes its classification with the Internal Revenue Service. In practical terms, the choice between Form 1120 and Form 1065 affects how income is taxed, how profits are distributed, and the overall complexity of tax compliance. Corporations face potential double taxation but can benefit from certain deductions, while partnerships enjoy pass-through taxation and flexibility in income allocation. Understanding these differences is essential for businesses to comply with Internal Revenue Service regulations and optimize their tax positions.